Okay, ladies and gentlemen, in this video, I'm showing you why options traders need to be watching the futures markets and why futures traders are leaving an edge on the table if they're ignoring the options markets. Basically, it's a real example of how options flow tells futures traders something the chart won't, and how futures positioning tells option traders the same thing in reverse. Okay, so let's get right into it. What we're going to look at here is the SPX, which is the S&P 500 cash market. All right, so if you trade zero DTEs, it's likely that you trade the SPX, the XSP, maybe some of the NASDAQ or Russell futures. This is in our options model under zero DTE. I'm going to show you the signals that our platform generated and why. And it had nothing to do with the charts. It had everything to do with VIX, IV ranking, realized volatility, and variance risk premium. Okay, threw some other filters in here with IV and VWAP, but based on volatility. It has nothing to do with the charts. So keep these numbers in mind, 925 and then 1126 to 1131. So let's just round it down and say from 930 and 1130 with the key times. So at 930, our SPX, our zero DTE traders, got a signal and the credit received was 480. Okay, that's a bear call spread. So for you futures traders who aren't familiar with a bear call spread, it's a bearish position. Okay, so options traders make money, they collect premium, and they make their money by having the market fall. As you can see here, the market fell from 925 from as high as 74.76 all the way down to 74.23. That was a big move. That's the cash market. I'll say it again. They are interconnected, and this is the dog. The dog wags the tail, which is the futures contract. This is much big. This is over double the size in terms of notional value of the futures markets. All right, so this is what the big institutions trade to hedge their positions. This is what insurance companies, pension funds, big asset holders use to hedge positions. So again, at 9:30, we got a bear signal, and then at 11:30, we started getting a bunch of bull signals, bull put spread. If you're a zero DTE trader, you know what that means. So remember, 9:30, 11:30. Now let's go over to the futures market and see what happened. So surprise, surprise. And believe me, futures traders, I'm going to show you how this can help you. I'm going to get rid of these moving averages. This was 9:30. At 9:30, right here, we got a signal. We got a trigger signal to go short, and we had VWAP right here. But we got a hard rotation on the 1-day cycle, 3-day cycle, and the 6-day cycle, which were all pretty much in sync. And on the macro, we were below. We were still in bear mode. So you can see down here, negative, negative. So we're in bear mode. And we also had probabilities of mean reversion. So early in the morning, the market, our indicators were telling us there's over an 85% chance of a mean reversion. Okay, that's changed because the day ended, and it's the extended trading market right now. But let's take a look at what happened. Remember, I said 9:30 and 11:30. So at 9:30, what happened? Right here, the market fell from 75.11, let's call it 75.10, all the way to say 75.70. So that's a 40-point move to the downside. Then what happened? Then we got a rotation, and what time was this? I'm sorry, we had a deep move with a high probability of a mean reversion down here at 11:30. Look where 11:30 is. So 11:30 was down here, and if you're a futures trader, you're asking yourself, geez, I wonder if this is going to go lower. Could this reverse here? Well, if you had fit platform, you would have seen the gamma levels. You'd have got the implication that we're about to reverse and go long. So 1126 and again 1131, it said, I'm sorry, actually short a bull put spread, but it's a bullish position. So we reversed, and then we reversed from 75, let's just call it 75.70, all the way up to 75.33. All right, so 60-point reversal, beautiful move. And then the other thing, if you're an options trader, you could have looked at this and said, yeah, I feel good about that bear signal, even if I waited till 10:20, because I got a cyclical rotation. This is realized volatility expressed over here as P&L. So I got a bear signal here, here and here. Let's take a look at standard deviation. Yep. Look, I didn't even break above the zero line, so my z-score stayed bearish. So by 10 o'clock, I would have felt very comfortable. So between my z-scores, between a cyclical rotation here and reversal signals on the 0 DTE, I knew it was time to either, in worst case scenario, take my short positions off the table. If you didn't want to re-enter the market, fine. Take your 480 or whatever you would have netted and go home. Or reverse, take that and make another 450. That was a beautiful trade. That was a beautiful trade. So there you have it. Really simple. This is the dog, this is the tail. One makes the other better. The better you are at reading the outrights, the better an option trader you'll be, because you already know the Greeks.